Hi, I'm Ms. Bergeron, and I'm going to be talking about financial statements today. So, as accountants, our job is to assemble all the information and ultimately communicate it to the users of the financial statements. So, what are the financial statements? So, after we have recorded and summarized all of the data, we are going to be preparing reports that are called financial statements. So, the main four financial statements are income statement, statement of owner's equity, balance sheet, and statement of cash flows. We need to prepare them in this order, and as we go through, you will see why. So the income statement is the statement that we will prepare first. It is the statement that reports the revenues and expenses for the period. So all of our revenues, which depending on the type of business that we have, could be called fees earned, or could be called sales, or could be called commissions revenue or interest revenue. Whatever our revenue accounts are, they will go first, and then we'll subtract out all of our expenses. So it's important to notice right here that we are saying revenues. So that means that cash, which we may have received as a result of a revenue, does not go on the income statement. Cash is an asset, so we're going to report it on a different financial statement. So this is just our revenues and expenses. Okay, so on our income statement, we will be applying the matching concept. This means that we are going to report in the period. So for example, we have a January income statement. We're going to report the revenues that we earned in that period. Doesn't matter if we've gotten the cash yet or not, but if we've done the work, we've earned them. And also the expenses that we incurred during the period that we earned the revenues. So in other words, whatever expenses we needed to incur to help us to earn those revenues, those are the ones we're going to match into the period. All right, so the excess of revenue over expenses, which is good, that means you have more revenue than expenses, is net income. If the opposite happens, that is, if your expenses exceeded your revenue, that would be a bad thing, then it's a net loss. Okay, so the income statement of Chickadee Travel Service could look like this. Fees earned, that's the revenue account, minus all those expenses. So here's what it would look like on an income statement. You would list your revenues, then you would group all of your expenses together, and then out to the side you put a total of these expenses to get to net income. So it's very important to remember that these are not debits and credits. We have different columns because we're doing subtotaling and totaling. So because we only had one revenue account, we went ahead and put it in the totaling column. But we had several expenses, so we put them over here so that we could total it here. That gives us a nice clean look at revenues minus expenses equals net income. All right, the next statement that will be prepared is the statement of owner's equity. It's going to summarize all the changes that happened to owner's equity. So at this point, it's important to remember what does change owner's equity. Well, revenues make it go up, expenses make it go down. But we've already put all the revenues and expenses on the income statement. So we're not going to put them again, but we are going to summarize them into one number called net income. So net income is going to go on to it. All right, so here's what we have. This is an example of the statement of owner's equity. So remember I told you that net income is going to go on to it? So the other two things that can affect owner's equity are also investments by owners, we put it here, and withdrawals by owners, we put it there. So because we're summarizing what happens to owner's equity, we begin with a beginning number. They give it to us. They say this is what happened at the beginning of the year. That's what we started with. Then these are the things that changed it during the period. This is a subtotal of the things that changed it during the period. And the ending capital is made up of beginning plus what changed during the period equals the ending. And we use the word capital and owner's equity interchangeably. So we call this a statement of owner's equity, and we call this beginning capital plus what changed it equals ending capital, summarized on the statement of owner's equity. The balance sheet is the next statement that we will prepare. So what's different about the balance sheet is that instead of being a range of time, like the income statement and statement of owner's equity was, I gave the example of being for the whole month of January. The balance sheet is just a moment in time. So for this example, this is just the balances that happened at April 30th. It doesn't span a time, so we don't say for the month ended or for the year ended. We just put the date because it's that moment in time. Okay, so here's the data that was given to us. We have a liability, an asset, an asset, an asset, an asset. So what goes on the balance sheet is just the same thing as what you see in the accounting equation. That is assets equals liabilities plus owner's equity. So here it is. Assets, we list them out, get a total. Liabilities, we list them out, get a total. And owner's equity. This is important to note that this capital account has to come from the ending amount you calculated in your statement of owner's equity. That's why we prepare it after the statement of owner's equity. All right, so then we say total assets equals liabilities plus owner's equity. So we can see it in this format. It's also sometimes seen side by side. So sometimes you'll see assets over here and liabilities plus owner's equity over here. Just depends on how many columns you want to use when you prepare it. But either way is fine. So the statement of cash flows is going to be our final financial statement. It is going to summarize what happened to cash. So if you look at your beginning cash and your ending cash, it's going to summarize the change. It's going to break down everything that happened to just cash into 3 sections. Operating, this is the normal daily operations. If it brought in cash, you put it here. If you spent cash, you put it here. Investing, this is your investments in your business, like when you buy new equipment or you buy a new car or you buy a new tractor. That would be investing activities. You invested in your business. So that would mean outflows. And if you sold a tractor that you had been using in your business, that would be an inflow. That's what you put in investing. Financing are all other areas such as owner investments, owner withdrawals, and if you were a company, it would be the issuance of stock or the payment of dividends. All right, so the statement of cash flows will look just like this. We have cash flows from operating activities, and we break down the cash that came in and the cash that went out to get to the net cash flow from operating. Cash flow from investing activities, in this case, we just purchased some land. So that was a cash outflow. Cash flows from financing activities, we had an owner investment that made it go up and an owner withdrawal that made it go down. So we get to the net cash from financing. The net decrease in cash was calculated by saying from operating, from investing, and from financing. So $41,000 minus $80,000 plus $20,000 gave you a negative $19,000. Here's our check figure. We look on our balance sheet. Cash as of May 1, our beginning balance of cash was $72,050 and our ending cash was $53,050. So if the difference of that equals negative 19, we know that we accounted for everything correctly. So our checkpoint for the cash flow statement is that beginning minus ending equals the amount that we calculated when we looked at operating, investing, and financing. Okay, so let's look through this again and see why we go in this order. We calculated net income, and we needed that number to go on to our statement of owner's equity for net income. Then we needed the number from the ending of statement of owner's equity to flow through for our ending capital on the balance sheet. This ending cash number, $5,900, can be seen as our ending cash balance on our statement of cash flows. All right, so this is the report form of the balance sheet, which I mentioned earlier. We can see it in an up and down format. And then the other section, there's not one on here, but it would just have cash over here, assets over here, and the liabilities plus owner's equity over there. And that would be the other way that you can look at a balance sheet. But regardless, your balance sheet has assets equals liabilities plus owner's equity. That's why we can see total assets here and total liabilities plus owner's equity here. And remember, no financial statements will have debits and credits because we prepare these for users of the financial statements. They're not necessarily accountants. They can be investors, they can be banks, they can be managers, they can be creditors. So we do not use debits and credits. We are just reporting the numbers as pluses and minuses. Okay, so we can always make financial statements more meaningful by using ratios, and we will discuss that even further in future lectures. But the one that we want to bring up right now is the ratio of liabilities to owner's equity. We can divide total liabilities by total owner's equity and get the ratio. And this is useful in analyzing the ability of a company to pay its creditors. So we look at how much do we owe our creditors and how much total owner's equity do we have available for that. So we divide and we get this number. And in order to make sense out of this number that we get, 0.015, we would need to compare it to prior years or to other companies within an industry to see how strong we are in this area. So ratios are helpful when we compare, and then we can say that our trend is favorable or unfavorable depending on whether or not we're getting stronger or weaker in our ratios.